Hi, everyone. Today, let's talk about my year end review for Fundrise. I know I'm a little late getting to this review, but I did want to wait until the year end investor letter came out, which did come out on January 21st. So I will start off this episode by going through all of the things that they talk about in this letter. And then, of course, I will go over my individual returns for 2020 with Fundrise. Then I will finish up with my future plans for this platform. If you like investing and making money, definitely like and subscribe. I really appreciate all of the support that I've been getting recently as my channel continues to accelerate in its growth. So continue to like and share as it really helps my channel grow. Welcome to the Portfolio Bulletin. Let's get started. So the year-end letter for Fundrise. They start off by comparing their returns to VTI, which is the Vanguard Total Stock Market Index, as well as VNQ, which is the Vanguard REIT ETF, which is a conglomerate of multiple public REITs. And compared to the total stock market, they did underperform by quite a bit. But you can see here they didn't have nearly the volatility that the stock market did, dropping over 20% in Q1. Fundrise did continue steady growth throughout the year. REITs dropped well over 20% in Q1, recovered slightly in Q2 and Q3, and ticked up here into Q4, but we are yet to break even on the year if you own the VNQ public REIT. So they are outperforming REIT ETFs, but not the overall stock market right now. Also, it's worth mentioning here that their historical returns are higher than 7.42% generally, and I will talk about why this was the case this year, and it wasn't just the Rona. For the first time, Fundrise actually put on a recording of the entire letter, so if you want them to read it to you, you can actually do this. But I'm not going to read the whole thing, obviously. I'm going to hit the highlights and the things that are worth mentioning. So they start off by saying, of course, every industry was affected by the extraordinary events of 2020, and Fundrise was, of course, part of that group. They say the fact that they prepared for the downside allowed them to handle the situation pretty comfortably and continue to maintain positive returns over the past 12 months. 2020 was a deep test of the Fundrise platform, and it demonstrated the durability of their business model. I completely agree with these statements. I'm glad to see that a relatively new investment platform handled the downturn pretty comfortably, with only a little bit of losses on a couple of funds, and they were all very minor compared to the roller coaster that was the stock market this year. They then highlight the returns that I mentioned at the beginning. They outperformed the publicly traded REIT, VNQ, but underperformed the overall market. And then they compare this to the last couple of years. So VNQ did really well in 2014, not as well in 15, pretty standard years in 16 and 17. It was negative in 2018, came back pretty aggressively here in 2019, and then was negative for 2020. Comparing to Fundrise during those periods, they had a good year in 2014 and 15. 2016, they were on par with the public REITs, outperformed in 17 and 18, underperformed in 19, and then outperformed quite a bit here in 2020. Again, you can see these are very consistent positive returns compared to the Vanguard Real Estate ETF as well as the overall stock market. They say the results further validate their direct-to-investor, technology-enabled long-term approach, but of course they want to tell a little bit deeper story of everything that took place over the last year. They remind investors that at the beginning of 2019, they were a little bit conservative in their approach, while there was quite a bit of optimism for the coming year, and they were correct to be conservative, as nobody could predict the black swan event that was the Rona. They were concerned that there was a bubble forming before the Rona was even widespread, and as soon as it was announced, there was a huge downturn. They say, obviously, black swan events cannot be predicted. However, they were moving forward as if one could always occur. They consistently played multiple downside scenarios, and they could have never imagined what was to come with the Rona. However, the fact that they did prepare for all of these scenarios did allow them to return positive cash flow to investors, despite what the economy was struggling with. They then restate the fact that this was a definitive test for their platform as well as their investors, and during this time they did hold a higher level of liquidity in order to maintain their solvency and reduce any short-term risk. And this is what I wanted to mention before. So they did perform pretty well during this period, despite being down from their historical averages of just over 10%. And this is partially why. So they held a higher level of liquidity, meaning cash. They held a lot more cash in reserve to ensure that the company stayed solvent and they could pay any short-term debts. And whenever you're holding cash in an investment account, that cash goes towards your overall balance, which reduces your growth because that cash is not producing growth, whereas your investments are, which then acts as a drag to your overall returns. Now, it seems prudent that they did this because, of course, that liquidity is important to stay in business, especially during times of difficulty like this. But of course, it will reduce your returns. They also said this was not just a test of their platform, but in fact their investors. And their investors stuck with the platform better than they expected, which then allowed them to store more cash on hand to weather any turbulent times. They say as it unfolded, they were inspired by their investment community, which was proud to be invested with them for particularly turbulent times like this. They do mention here that they did minimize the amount of investors that were able to liquefy their investments through July, but around that July timeframe, they did allow anybody who wanted to withdraw their money to do so, which was very few. This has been one of the complaints with Fundrise, that their investments are generally illiquid, which is true. You should try to maintain your Fundrise position for the long term. It is real estate, and a 5-year time frame is pretty standard for any kind of real estate investments. But if you are playing the short game and you want to invest with Fundrise for shorter periods, which I do not advise, they do allow you to cash out at specific times, but understand they do maintain the right to not allow you to withdraw if they need that money for investments. But once they were about halfway through the year, they did allow people to start withdrawing money upon request. Moving on, they start talking about a little bit of general trends across the real estate market. They say public REITs experienced a K-shaped recovery, which was pretty choppy, but it was supported by things like growing demand in logistic facilities, as well as dropping inventory on the overall market, and probably the most impactful was overall low interest rates. This allowed real estate investors to stay in business, either through refinancing and paying low interest, or going directly into temporary forbearance so that they didn't have to pay their mortgages, at least for the short period of time. And as real estate investors, they understood the fact that a lot of their properties could potentially sell for 30% less than what they could be worth in a good market. So through forbearance, as well as low interest rates, they held onto these properties, and Fundrise wasn't really able to take advantage of this downturn as much as they thought that they might be able to. And because of this, they didn't purchase nearly as many assets as they had planned on initially, thinking that the real estate market might downturn and they could pick up some cheaper properties as good investments. They say they finished the year with $265 million in cash on hand, which represents around 20% of their $1.3 billion of collective equity. Anytime you're holding 20% in cash on hand, you're obviously going to create some drag on your portfolio, which is what we spoke about earlier. Of course, most of that is going to be invested in the first half of 2021, with over $350 million in deals under contract expected to be closed during that period. They mention again, holding that amount of cash will lower returns in the short term, but of course it's necessary to keep them in business. They also mention having large amounts of cash on hand tends to disproportionately impact new investors, as they are mostly invested in ramping up funds that aren't generating high amounts of return, and historically their returns grow and improve over time. And they also demonstrate this over the past few years. They show the different plans that they have in terms of income, balanced, and growth. And if you start with income in the first less than 1 year, you'll receive around a 5% return. And then at the 5-year mark, you should expect that average return to go up by around 3%. And then lastly, for this article, they talk about their future potential. They see the vaccine as starting to break through the Rona and save countless lives. Second, they offered a new, larger fund. If you have more questions on that, I did make a video specifically for that, and I will link it above. But basically, it has a larger capacity, more liquidity, and more diversification. Third, they expect the real estate market to lag a little bit behind the overall stock market, and as things continue to improve, they expect real estate to grow behind it. And lastly, they expect the federal government to continue to provide stimulus and keep rates at all-time lows, allowing them to purchase more assets at a lower cost. Full disclosure here, I am a shareholder in Fundrise. I own 500 shares of the stock that they offered in an internal offering to investors. And I'm happy to see all of the things that Fundrise has done to weather this storm and continue to grow in strength and returns for investors. If you like Fundrise as a platform and you're not invested yet, There will be a link in the description that will get your investor fees waived for the first 90 days when you fund your account. Moving on to my individual returns here for 2020, you can see I returned an average of 6.9% for the year, which was better than last year, but you can see here in 2019 was a partial year for me as I started investing in that year. But I received almost 7%, which is not far off of what they consider to be their average for the platform. And you can see these REITs that were in full operating mode did return pretty high returns. The West Coast REIT struggled a little bit, as well as the Fundrise eFund. The growth rate REIT 2 was stabilizing, but still had good returns. And then the income REIT didn't do as well at 1.7%. And then here's all those funds that they were talking about, all these ones that are ramping up. These are majority sitting in cash. So you have funds that are returning 0, which is definitely going to bring down your overall average. Somehow this fund had 11.5% even though it's in the ramping up phase. Not sure exactly how that happened. Then we have another one here at 0%. And then we have the interval fund, which is that new fund they just introduced. And it didn't have any returns because it started at the beginning of the year. And then the National eFund, which was a merger of a couple of different funds to include the Washington, D.C. fund. And then you can see my weighted average here at just under 7%. I also want to mention briefly here that my actual investments with them is $24,000. And you can see here the IPO that I purchased was just over $4,200, and that was the 500 shares that I mentioned before. So when I talk about that 7% return, that's only on this money. They do mention a little bit of growth with shares in terms of what they would offer shares again. But of course, this is just internal pricing as these are internal IPOs and you can't actually sell these on the public market yet. So in terms of value, it's hard to say exactly what these would be at if they were available publicly. Looking at their goal tracker here, you can see I would like to get it to 500,000 by 2040. But focusing more on this year, I do have an auto invest of $550 every single month, which means I'm planning to invest $6,600 in Fundrise, which should get me to the actual invested value of around $30,000 without any growth. And in terms of return, I expect around $2,000 of actual growth. So I'll set my goal at around $33,000 to $35,000 in terms of invested cash with Fundrise, plus the $4,000 that's invested in the actual Fundrise IPO. So my high goal for the end of 2021 will be around that $40,000 mark, with a more realistic goal of somewhere around $36,000 to $37,000. And lastly, looking at goals here, you can see the different accounts that they offer. So core for $1,000, I met that requirement. And then they have the $10,000 option, which is the advanced investor platform, which is the one that I'm in currently. And then the long-term goal here is this $100,000 minimum, which is their premium investment platform. I'm not sure if this requires you to be a accredited investor, which I am not. You have to have at least $1 million in net asset value and net worth, or make somewhere around $250,000 per year. Of course, that is the goal one day, but I would still like to see what the requirements are for this $100,000 account value and what specific opportunities they offer with this account level. Again, if you're interested in Fundrise as an investment platform, there will be a link in the description that will get you your investor fees for the first 90 days. If you're an investor with Fundrise, let me know what your annual returns were for 2020 down in the comments section. And if you're not an investor with them, let me know what you thought of this video and what you think of Fundrise as an investing platform. Definitely like and subscribe if you got any value out of this video. Thanks to all the growing support and growing subscriber numbers. Of course, none of this is financial advice. This is all for entertainment purposes. And have a great day.